Hi everyone, and welcome to our second in a weekly series of property webinars aimed at providing insight into the international property market, as well as exploring some fantastic individual investment opportunities. My name is Anthony Palmer, Group Commercial Director for Carrick, heading up products and investments. Today's format is very informal, so please feel free to submit questions as we go along, and there will also be a question and answer session at the end. Every investment that Carrick Property brings to you has been through a thorough diligence by our investment committee and are what we believe to be some of the most exciting and best opportunities out there. Property is a key building block in an investment portfolio, and I personally believe that the investment case for buying property has never been stronger. Why would you want to own bricks and mortar property in a developed market? Well, firstly, you can use the power of leverage to boost your returns, especially in the low interest rate environment we're currently experiencing. Secondly, our clients love retaining control, which means being able to renovate, to rent, or sell according to your personal wishes. Thirdly, you generate stable and consistent cash flow in a hard currency. And finally, it is obviously a great inflation hedge. Property is a real asset that retains value independent of any paper currency's nominal value. These are just some of the reasons, but to help us understand a little more and to explain what has transpired and what we can expect going forward, specifically with respect to UK property, is Tom Bland from IP Global, one of Carrick's key property partners. Tom has over 25 years of experience across the property sector, 22 of which he was in specialized structured finance within property. Tom was also a director of SPF Private Clients, which was part of the FTSE-listed Savills Property Group. He has been with IP Global for 4 years and heads up their South African office based out of Johannesburg. Tom, welcome to today's webinar and great having you here as a guest again. I know that our listeners are super keen to hear what you have to say today.
Anthony, thank you very much. And to all our listeners, thank you very much for logging on. Very much looking forward to going through this presentation with yourselves. And as Anthony said, please, it's very difficult in such a short period of time and making sure I don't lose all your interest in being overly analytical on everything. So it will be a fairly broad overview on what's happening. So if you do have any questions, please do submit them, and Anthony and I will be very happy to answer those. So just starting off with thanking Carrick. Carrick have done tremendously well over the last few years. Their commitment to making sure they put their clients first, looking after their financial objectives, is being very apparent to IP Global, and we're delighted to be in a relationship with them and being one of their prime product providers. So without further ado, I'll just go through the agenda for today's webinar. So just a very quick recap on the benefits of direct property investment, just to add a couple of things that Anthony's already mentioned. Who are IP Global and what do we do? Some quotes from the experts about the UK property market. So within that, I'll just have a recap on what's happened over the last few years, what the 2020 year had, what transpired during 2020 within the property market, and obviously most importantly, what's going to be, what we believe will be happening going forward in 2021 and beyond. After that, current opportunities with IP Global within the UK property market. Again, I won't be going into specific details, but give you a good overview on what's available. Financing your investment, I think it's a key part. It obviously is one of the main benefits of direct property investment, leveraging, but you need to make sure you do get it right. I'll just go through some cash flows and projections, which I believe for any investor is important to have a look at, so you understand exactly what the costs are going in during the ownership and exiting. Together with, in closing, just a few tips that I'd like to make. But like I say, please, if you do have any queries or would like me to elaborate on anything, do submit those questions and I'll happily go through them. So direct property investment is it's a great way of diversifying your investment portfolio. We often, financial advisors in Carrick specifically, will talk about the benefits of a diversified investment portfolio. So obviously property adds to that diversification as being a different asset class. Direct as opposed to indirect property ownership. So again, just repeating what Anthony said, control over your asset. It's a tangible asset. The ability to leverage your investment at competitive interest rates. We've been in a very low interest rate environment for some years now, and that's certainly had tremendous effect on the return on equity, or what some people like to look at, the internal rates of return. I'll show you how those have benefited later on. Get exposure to a less volatile currency than the one in which you derive your income. You know, we all know, those that are based here in South Africa, we have one of the most volatile currencies. So having an asset that's offshore, that's either a euro or dollar, or in this case, obviously a sterling denominated asset, is hugely beneficial. Then with regards to, as in any asset class, looking at the risk, would property, as long as it's kept from medium to long term, would be classed as a low to medium risk asset. Far less volatile than the stock market. You know, it's really, property is about a medium to long term view, a passive investment, and not overly worrying about movements within the market in the short term. And then far better returns than sitting in an overseas bank account. I think that's pretty obvious with regards to low interest rates and what sort of returns you're getting at the moment. So without further ado, I'll move on to IP Global. We're a full service property investment company that helps investors add the strength of global real estate to their portfolios through the focus on research, due diligence, and our experience. So what we do, we're not an estate agent and we're not a developer. So our aim is to act on our client's behalf, you as the client, and obtain great opportunities for investment within the property sector. We've specialized purely in the residential sector, and the majority of what we do will be off plan. We're founded in 2005. Our head office is in Hong Kong, further 11 offices around the world, mainly in the Far East, Middle East, and Europe. And then there is my office here in Johannesburg, and we've got an office in Kenya. We offer a diverse range of investment opportunities. So it's not a case of having one opportunity at a time and promoting that opportunity. We will have several opportunities, normally circa about 10 different opportunities in different locations, different countries, that will have a wide range of prices and also varying completion dates. So why we have that is because we're here to advise clients based upon their requirements, their cash availability now and in the future, to make sure we put in front of them the product that fits their requirements and their needs. So in a nutshell, we're a company that's got 15 years experience, which I think is hugely beneficial. We've got a proven track record of delivering returns, and our focus is recommending investment opportunities that fit your requirements.
Tom, if I can jump in there briefly, please. For me, and it's important for our listeners to understand this, Carrick Property chooses its partners very, very carefully, and skin in the game and alignment of interest are critical points that we consider. What Tom mentioned there, you know, they are putting their own balance sheets at risk. If those products are not sold, if the apartments are not sold, IP Global, its neck is on the line. And for us, that means that research and that diligence that Tom mentioned that IP Global are doing is real, and that all of our interests are 100% aligned.
Absolutely. Thank you, Anthony. I've got a slide on that, which I'll go into a bit of detail on that. But again, like I say, ladies and gentlemen, I don't want to spend too much time going into the nitty gritty, and hence, you know, if you do have questions, please do submit them. The track record, we've been around for 15 years, but what have we done in that 15 years? Well, we've done about $3.2 billion US dollars across 32 different markets. Absolutely, historically, the UK has been our biggest market and will continue. It is the biggest investment market when it comes to residential investment. But historically, we did a lot in America. and Australia. We entered the market in Berlin. We actually entered into Frankfurt in about 2008, but we entered into Berlin in about 2014, one of the first to enter, and we're still very much active in Berlin. We're also in Leipzig, and over the last couple of years, we've been active, not from a golden visa point of view, from an investment point of view in Portugal, in Lisbon and Porto. So, you know, a diverse range of opportunities, and we continue to look at any opportunities that we feel will benefit our clients. So what is the basis of IP Global? Well, we call them the three pillars. It's research and due diligence. It's our underwrite model, which Anthony referred to, and our end-to-end service. And they all equally are as important as each other, and obviously the sum of the parts is greater than the individual. So just going through them very quickly. Research and due diligence, you know, I don't want to overcomplicate what property investment's about, because some people do try and make it too complicated, but behind the scenes there is a lot that goes on. And the way we start off, and this is through experience, because what we're looking for is to keep what I mentioned earlier, the investment as a low to medium risk. So right from the get-go, we only look at tier 1 safe haven countries. Those are countries that are stable politically and economically, with growing diverse economies. We need transparent legal systems and ownership rights. So, you know, as a foreigner, can you actually buy there? And then are you very well protected? And that's very important, because there are opportunities, and we don't disagree with them, you know, in for example, Eastern Europe or some more exotic locations, but you need to look very carefully at ownership rights. And I mean, that even goes down to somewhere like Spain. I'm not trying to have a go, but there were a few investors that ended up losing their money because the legal system didn't give them the full ownership rights they thought. So you've got to be very careful, and this is obviously part of our due diligence. And then mortgage finance, it's hugely beneficial for leveraging, and we can't enter into any markets where, as our business model is, where there isn't financing available, because the majority of our clients will use financing. Location, you will always hear location, location, location. There's a bit more to it than just that, but fundamentally what we're looking at is supply and demand and an imbalance, not just right now, but going forward for the future for some time. Basically, people refer to PI, it's population, infrastructure, employment and economy. Those are factors that we're looking at. Are they moving in the right direction? So we'll analyze those. Other factors that could come into play, connectivity, you know, for example, an extension of a railway line, or the location, how well is it connected, not just to the city itself where its location, but to other parts of the country in which it's located, and to a degree the rest of the world or Europe, in the case of the UK. And regeneration, there's a lot happening, and there are a lot of markets, I would say, just as an example here, Liverpool, where you've got the Mersey and the docks. The whole docks have been regenerated. You know, there's a whole regeneration going on there, and a whole lot of both commercial and residential going on. And there's that happening a lot within a lot of the regional cities within the UK and London itself. And then, very importantly, we analyse the developer, their track record, the quality of their build, their timings, and then obviously their financials, to make sure that you know, that they are liquid and in a good financial position. Having been in the UK for so long, having done almost $3 billion, you know, we do know the developers very well, and we tend to use the same ones again and again, but there's quite a diverse range there. So just the underwrite model, skin in the game, money where your mouth is. Very simply, how does IP Global make our money? Well, we make our money by taking some risk off the developer. So in a nutshell, we will find the location we like. We've done the due diligence on the developer. We'll approach them, and let's say, for example, they've got 100 units that they've got planning permission for. We'll either take 50 or maybe even all 100, and we'll commit to selling all those apartments. Now, just taking, for example, the 50, it takes risk off the developer. It gives them exposure for that sell. It obviously takes risk of future movements, but we'll put in our own money. We put in 10%, and currently we've got about $23 million invested in different schemes where we only get our money back once the entire development is completed. In addition, we commit to, if we don't sell any of those units and completion comes up, we will buy them. So it's an absolute no-brainer for the developer. And because of that, we get a discount on what the true market value is, and that's where we make our money. So the developer benefits, we benefit, and you as a client benefit because you're now getting a very well-researched product, off-plan, off-market, and you're getting it at what the market price is because we're making our margin on the discount we get by our underwrite model. So that's how that works. And then end-to-end service, and I often hear this as key, and the reason being is because, you know, a lot of clients are buying in countries far away from where they're located, and here obviously for South Africa and the UK, quite some distance, and maybe even in places they've never been. And what you need to make sure is it's not just about finding that asset and buying it, but making sure that the entire process, you know, you've got someone that's there to help you continually through that process. So we'll recommend lawyers. They tend to be the lawyers that have done the due diligence and all the legal work on the development. Bond originators or mortgage brokers, as they're called, that will get you the best financing options that are available based upon your requirements and what's available in the market. And then most importantly, managing agent. We've got a sister company called Complete. They are a managing agent. They have about $1 billion of property under management. Before the pandemic, they had a 98.4% occupancy rate and a 0.4% default rate. That occupancy rate's only come down fractionally. There is a larger default rate, which is absolutely expected. But what they've done in those cases is made sure that they've negotiated between the landlord, and the tenant. And that's a process that would take a lot of time and effort and something that you really don't want to be involved in. And then what they do with regards to the development itself is they will do the snagging, the handover. They'll furnish the property should it be beneficial to have a furnished let as opposed to unfurnished. And then they'll reference and find the tenant. So just wary. I don't want to go through this too much, but so I'll leave this for you to have a read. But just whilst I leave this on the screen, just to recap on what's happened, we had fairly moderate growth, to be honest, between 2016 and 2019 in the residential property market. But 2020, you know, no doubt, and please forgive me for saying the obvious, was you know, obviously a peculiar year to say the least. But what was peculiar with regards to property is the fact that it's the first time in the UK that the economy and the property market have gone in different directions. So normally there's a correlation. If the economy goes up, property goes up, and if the economy comes down, property comes down. But 2020 was actually a year where obviously the economy came down, but property went up. And overall in the UK, the growth was around about 6%. That's a general figure, so you know you're obviously going to get different growth, and there are places which didn't grow, and London would be one where there was some drop in certain areas and certain markets. But you know, certainly an interesting year. The other thing that did come about was within property as an asset class. There are obviously various types of property. We specialize in residential property, but there's obviously commercial, retail, various other hotels, and office space, and those different markets have acted very differently compared to the global financial crisis of 2008. And basically what's happened is there are a couple of markets that have really suffered, most notably obviously the hotel industry and retail, and then obviously office space as well. And what this has brought about is there's been about a 25% increase in investors, both institutional and individuals, investing in residential property. So there's been a big increase, and that's because the fact that there's a demand for residential property. People need places to live, and also because there's a bit of uncertainty within some of those markets. You know, when will we finally get through this pandemic, and how quickly will the economy recover? And retail, what's going to happen? You know, we've all, you know, I'm sure you would agree, we all changed our way of shopping and doing a lot more online ordering. I wish I could get that right. I always have to send my goods back. I never get the right sizes. But, you know, that has changed, and that has meant that there is a far more conservative approach to those sectors within the property market, and it's been hugely beneficial for the UK property market and to be honest, the residential market and the residential market around the world. Now, going forward is the interesting bit. What's been happening in the UK? Well, let's start off with a couple of the obviouses. Brexit was having a huge impact. There has obviously, now that finally they've put it to bed, but there's still a lot of work to be done. There's still a lot of negotiation to be done, and Boris does tend to waffle a lot, but we hope he gets there. But it has, you know, relieved some of those that were concerned about the position with Brexit. So it's been a positive, but there's a lot more to be done. The other one would be stamp duty. The introduction of the once-in-a-lifetime waiver of stamp duty for properties up to 500,000 has had a huge impact. And to be honest, the impact has been so great that actually in December last year, 2020, the growth within the property sector was 13% up in residential property than it was for the previous year, December 2019. So it's having a great impact, but that comes to an end, and that comes to an end at the end of March. So the impact it's had really right now, there's been a lot of focus, and the focus is still there, and we have opportunities in markets within London or Greater London, where people are now able to buy up to that £500,000 mark and save on stamp duty, and that's obviously invigorated that market. But it's also meant that there's a lot of activity around the regional cities within the UK, and there are also other reasons for that. So once that stamp duty comes to an end, there is going to be a lull in the market. Savills predict that there is going to be a lull for a period of time whilst people, sorry, I've just got a network problem coming up on my system, while people have a look and react to what the situation's like, and then they predict some great growth. And as you can see on that chart on the bottom right, and with regards to the quote by CBRE, there is going to be a lot of investment within that sector. So going forward, we expect to see moderate growth and then a recovery going forward in 2022, and some great growth going forward. Financing your property, why would you finance it, and what's available, what to look out for, those that are risk adverse, and what are accept agreement in principle. So just very quickly, the financing, as mentioned earlier, leveraging, the ability to leverage has a direct impact on your returns on equity and also your internal rate of return. So the benefit's quite simple. It increases your returns, and people like that in a low interest rate environment. That obviously accentuates those benefits and returns. It also gives you greater buying power or greater diversity to use those monies in other areas. So for example, if you've got £300,000 in cash and you don't buy a property, let's say it was 300,000 for the 300,000, and you borrow 150, you need to make sure that under 150 is utilized and invested in the right way. Otherwise, if you just leave it in a bank account, you're actually not doing yourself favors, because you've got to look at your overall net position when it comes to your investments. So the reason why is obviously on the returns. What's available? This is a key point, because you need to ensure that you have a very clear idea of what is available within the market with regards to two fundamentals. Number one, the loan to value, so how much are you going to be able to borrow, and number two, the interest rates that are available. So right now, for South African investors, the loan to value tends to be capped at around about 65%. There are cases where you can get more, potentially up to 75, But in those cases, you want to make sure that you know that that is available. You never want to go into a position where that 75% is something you're going to need in order for this investment to work, because that is right on the extremes of loan to values, and there are other factors in play that may mean that they're not available for a lender that may have had them available because it's further down the line, or even something now where their exposure, for example, to that particular development has reached their exposure limits. There are various factors that will come in. So without going into too much detail, like I said, I'm a bit conscious of going into too much, but be very, do your due diligence and make sure that you dot the I's and cross the T's. So really, I tend to base it off around about 65% loan to value. And then in interest rates, they can vary. They can come down to as low as 3.25%, 3.5%. But I also tend to use a rate of about 3.75 to 4%. Now, it does depend on your circumstances, your past record, whether you've got existing lending within the UK, your nationality, and the loan to value with regards to interest rates. A low loan to value will give you the benefit of a better rate. So there are a lot of factors that come into play. So when it comes to financing, I'm just very keen, coming from that background, to make sure clients, make sure that they are going to get what they say. What to look out for within, and I don't want to again go into too much detail, but this has come up quite recently and it's coming up a lot more, is ground rents. If there is a property where the ground rent is more than 0.1% of the purchase price, lenders will not lend on those. And there are developers out there, the smaller ones, that will have increased ground rents, and it makes lending incredibly difficult. So don't be entering into any contracts where you haven't looked at that. For those that are risk adverse, well, the case is, as mentioned earlier, a lot of our investment opportunities are off plan, so they'll be 12, 18, 24 months down the line. For those that don't want to take that risk, but want to take advantage of off plan, then you really want to be looking at a property that's going to be completing within the next 9 months, preferably 6 months, which means you will be able to obtain and apply for your mortgage finance and have the peace of mind that that is in place. For those that just want to make sure that they are going to be able to, in principle, get it, an AIP, an agreement in principle, through the mortgage bond originator, mortgage broker, they will be able to do that for you. But be very aware that an agreement in principle is not binding. So yes, it's giving you the peace of mind that currently, based upon your current circumstances in the market, there will be lending available. So those are the things to bear in mind when it comes to financing. Just cost of finance, I just wanted to throw this in there just as just to show you how low interest rates have such an impact. So if you took out a 25-year principal and interest bond at today's rates, and after 10 years you sold the property, the interest you would have paid in South Africa on that bond over the 10 years would have been 92.9%, whereas in the UK it's 32.6%. So a third cheaper, and that has a direct impact on your returns, as I'm sure you can see. So just an overview. As I mentioned earlier, we have various opportunities, and I don't want to go into these too much detail. I'm also conscious of time, and would love to answer questions and things that you really want to know. But we've got an array of opportunities, just a couple in London. Why are we in the London market? Well, stamp duty, obviously, this is an opportunity which is in Kew. It's in Brentford, very close to Kew, Richmond area, so West London. A great development. It's that development over there. There is more pictures, but I didn't want to overload them. Got studios, they're all on the top floor, so they all have outside space, great views, very close to transport, very close to the Kew Botanical Gardens, and probably a 5-minute walk to the Thames, and very close to places like Chiswick for those, and Putney for those that are familiar with London. Studio apartments, it's ready for completion now. So for those that want to take advantage of stamp duty savings, brilliant opportunity. you'll save up to £15,000 by going ahead. And right now, because of the stamp duty, and I've put 65% mortgage, you potentially get 70, and just a great opportunity right now. The next opportunity, just again, a very broad overview on that. Westwood in Southall London. Again, the reason why we've gone here is going back to what I mentioned earlier about when we look at what factors come into play when looking for those pockets of value or areas you want to look at investing, which are going to give you good returns. One of the factors is connectivity, and the Crossrail, or the Elizabeth line as it's also referred to, is coming into play. And there's also a combination of that and the ripple effect, and the ripple effect being those people that can't afford the prices. You know, South Africans often talk to me, yeah, but I want to buy in, you know, somewhere like Putney or Fulham. I lived in those areas for, you know, 12, 14 years. You know, to buy a place there right now is about 35, 40% more expensive than an opportunity like this. And to be honest, takes the same time to get into work, if not a hell of a lot longer. So we try to take advantage of the connectivity, because a lot of people, the first thing when you look for a property, when you live in England, and those that have lived there will know this, the first question you ask is, how long is it going to take to get into work? That's the first thing. Budget comes second. So the great thing about this opportunity is it's 13 minutes into Paddington, 8 minutes to Heathrow, 17 minutes to Bond Street. So central London that quickly. Again, this is a West London opportunity, taking advantage of the Crossrail. Great opportunity. Again, taking advantage of the stamp duty saving. And just to put it in perspective about, you know, the connectivity and the Crossrail, these are two opportunities that we launched. So Station Road and West Drayton, again, West London, even further out, sort of slightly above Heathrow Airport. Launched in 2013, the growth has been 65.9%. Ilford, launched in September 2014, capital growth 44%. So as you can see, taking advantage of the connectivity can be hugely beneficial. Then just moving on to something slightly different, which is a commuter town, High Wycombe, which is in northwest of London. Great commuter town, and the real benefit for these type of opportunities is those people that don't want to or can't afford to pay the London prices, but obviously working there, or just don't want to work, you know, live in London, prefer the outdoors, so want a commuter town. High Wycombe in itself has got a great economy, which is expanding, but it fits that young professional type thing, individual. So a huge supply and demand imbalance there for tenants, and great investment opportunity for those looking at an alternative to London, and again the opportunity to take advantage of stamp duty savings. So those first three really, and it's no surprise that in London and the commuter town that we are looking at opportunities which are slightly different to our usual model, which would be more off-plan opportunities completing in 12, 18, 24 months. It's because we understand how the market has changed with the stamp duty saving, and what a huge benefit it is, and it's a once in a lifetime, as the UK government put it. So moving on, Newcastle. For those that are not too familiar with Newcastle, what's basically happening here, and just very quickly, something is coming back up again, and people are talking a lot about it, which is North Shoring. North Shoring was essentially about making sure that that south-north divide, which was becoming incredibly big, changed. And although there was a lot of talk about it, what really needed to happen was there needed to be a lot of investment up in the north, and that investment decisions needed to be made by the people in the north. So for their infrastructure and development and culture and so forth and so on. And that has had an unbelievable effect. And there were 5 main cities that benefited from this. That being Liverpool, and then Manchester, Leeds, Sheffield, and actually Newcastle being the last one and the most northerly of those 5 cities. So I'm sure those that have been looking or touched, dipped their toe into having a look at property investment, there's a lot said about places like Manchester and Leeds and Liverpool. And Newcastle doesn't come up much, but why we're there is because right now there is a lot going on. Finally, those funds are being ploughed into Newcastle, and it has the quickest growing economy of any regional city in the UK. So fantastic things happening there. This particular opportunity, it's a combination of a conversion of a Grade 2 listed building and a new build added onto that. It's right on the Tyne River, and fantastic location because it's only a mere 10-minute walk straight into the middle of town. The other thing we like about this is obviously price range, and for South Africans, with our rand, it's far more palatable, and a great opportunity to take advantage of. This good rental yield, it completes at the end of this year, and as you can see, 20% on exchange of contracts and then a further 80% on completion. So a fantastic opportunity, something I like a lot. Great university town, got 2 universities which are 2 worldwide known universities, and there's a lot going on in Newcastle, and certainly a place to keep an eye on. And then Birmingham, you can't ignore Birmingham, quite simply. And funny enough, on my last slide, there was something I'll cover, but just very quickly on Birmingham, again, not going into too much detail, but there's no doubt Birmingham is probably the prime investment spot and property market in the UK right now. But the Birmingham story, it is the 2nd biggest city in the UK to London. Its connectivity is fantastic. It's the most centrally located city. Its connectivity within the UK being so central is brilliant. The high-speed rail is going to make the connectivity to London unbelievable. Its connectivity to Europe is extremely good. And what's basically happening is you've got a relocation of a lot of different institutions, banking institutions like the HSBCs of this world, and job opportunities. You've got a hell of a huge growing economy that's diversifying, hitting all the right notes, going into the right sectors, and it's just a market that people like, and not just investors, but the analysts still like. The important thing is to get a place in the right location, and so important to make sure you get it at the right prices and at the right, have a very clear view of the yields. And the reason why I say that as a closing statement on this is because we looked at a potential investment not too long ago. It's just come on the market. It's right next door to an investment we did a couple of years ago, and the rental yields they're quoting are 30% above the actual rental yields that are currently being achieved, and the prices are 20% above where we think they should be in the comparable show. So it just shows you how important it is using a Carrick Wealth and IP Global to make sure that you are being represented and you are getting the right price points and you are being given realistic figures. So I'm conscious of time. I'm not going to spend any time on this, but I just wanted to flick up a few slides just so you know this is something that you will get from us and Carrick Property with regards to the investment. It's the cash flows, so all your personal details, the prices. I've just used a made up name and an investment share in Ark Avenue. That's the Newcastle investment purchase price, and you get all the details of the rate, what's required, and how much your bond will be, and then how much it costs and what the rental income is. So this is part of one page. This is all on the same page. Then it goes into your initial costs, what you're paying for example, your IP Global fee, which is refunded on completion, the deposit monies you're going to need on exchange, and so on and so on. And then final costs. It's so important that you have a very clear idea of exactly what your costs are going to be and when they're going to be due and how much they are. So you'll get this with every opportunity. This is still on the same page right at the bottom. This is at the end where we look at what the rental income is, the yield, and then what it nets down to be. You know, it's all well and good talking about a gross yield, but you want to know what the net yield is, and then just a forecast over the 10 years at the bottom here, which is cash positive at 104, and then obviously starts going up as the years go forward. And then again, very quickly, the next slide is actually the next page, which is our returns model. This is what we look at when we're looking at projections, taking growth rates. We can change the figures. We can use a basic growth, an optimized growth, or a conservative growth. And then, all importantly, you're having a look at these figures at the bottom. I doubt you can see them because even I can't see them, although I'm a bit blind these days. But essentially, you're looking at internal rates of return and return on equity. And as you can, well, I can barely see, but I think over a 10-year period, you're looking at about a 7% return for cash purchase, and that goes all the way up to about 10.2% when you leverage. So that's an internal rate of return. Return on equity, I believe, goes up from about 90% up to about, can't really see that, but it's probably about 135% from memory. So you can see the benefits there, but these are things that you need to look out for, and you really should be getting from anyone that's giving you solid investment advice.
Tom, maybe a good time to interject with one of the questions that have come up, which is, you know, interest rates are going to increase in the future, and what impact is that going to have on cash flows? What impact is that going to have on property prices?
Sure. That's a very good question. So there's no doubt, you know, as mentioned in the beginning, that low interest rate environment, it's been around for quite some time. I would say, firstly, I don't, and certainly myself, having been in that game, and the economists, they don't expect interest rates to rise very soon. You know, for the obvious reasons of the pandemic and the economy, the recovery of the economy. But that's not to say that you shouldn't keep an eye on it. So first and foremost, you can either look at taking a fixed rate, so lock into a rate which gives you peace of mind, and you know that it's fixed for that period of time. Or take advantage of low interest rates, and then when the decision comes to either taking an interest-only product or a interest and capital repayment, or principal and interest, as you call it, you can reduce the debt, that by the time interest rates goes up, and if your interest rate is going up, the growth, as in the previous cash flows there, you'll have obviously the projected growth within the rental income, but you'll be getting greater rental income, and your debt that's owed will be less, and you can get another product where the rental income will cover the mortgage costs. But you know, the case is that rates have been low for quite some time, and you know, really it's not an immediate concern, but for those that are ultra conservative, then the fixed rate peace of mind opportunity is what you really want to be looking at. Going forward, what you know, what effect is it going to have on the market? Well, you know, I was based in London when there was a lot of property investment during the noughties, when rates were you know, at the levels, base rate was at 4%. So interest rates, the margins they were taking then weren't as great. So, you know, sort of maybe more 50 basis points, so 4.5%, 5%, even going up to 6%. There was huge growth within the market. What you've got to look at is not just what impact interest rates are going to have, but making sure you buy in the right areas where there is that huge imbalance between supply and demand, because the fundamentals are that even with rising interest rates, when there is a lack of supply and there's a huge demand, people need property and prices will continue to go up. So great question, by the way. It's you know, these are the kind of things you want to consider, being an astute investor. Just very quickly again, and then I'm done, ladies and gentlemen, and I'd really encourage as many questions as possible. So this was something done, you know, this was back in 2013, an independent report done by Savills PLC. I wasn't even with the company, nothing to do with my background. But the reason why I wanted to put this up was just to, again, I mean, this was just great timing with regards to Savile, regards to IP Global and where we invested, but just to show you the kind of effects it had, the ability to leverage. But I also wanted to put this in there because a lot of our projects within this were based upon the extension or the announcement of the Crossrail, the Elizabeth line I mentioned earlier, and how well we did that, looking at opportunities in places like Ilford and places like Greenwich, Woolwich, and further east in the other side of Canary Wharf. And then further up to areas that people really didn't think much of. For example, when you sort of go north towards the Olympic Park area in the northeast of London, or east northeast really. So taking advantage of these opportunities is what it's all about, and it's what IP Global's about. It's what we do is we look for those pockets of value. So it's all well and good knowing Birmingham's going to go up, but it's a big area, it's a big town, big city. Lots of different areas. What are they going to do? It's finding those great opportunities in the right spots with the right investment case and rationale as to why it's going to outperform the other areas within Birmingham or wherever the case may be, and making sure you're getting it at the right prices and costs. I'm sure, I'm rather hoping, and I'm sure most people are hoping this is my last slide. So in closing, points of advice: don't let the property become personal. This is not about, this is an investment. It's not about, well, I really want the property to be in, like I said, because I get it often, Putney. Us Sappers, we all lived in Putney, or Fulham. I like those areas. I don't really like that area. I mean, who would live there? Birmingham. I mean, yes, 2005, 2000, I didn't particularly, I wouldn't live in Birmingham if you paid me, but things change, and to be honest, it's not about that. It's about the investment. So don't get personal about it. The place is small. Again, we've done our research. We know what the market wants. It doesn't look nice. All these different things. When you see an offer that's too good to be true, we all know the default. So just be wary of things. Things like rental guarantees. We once in a while give them, and certainly with this pandemic, we've put that into play, but we've taken a loss ourselves or reduced margin on our profits to do that, because we know that clients want peace of mind. But when people offer a rental guarantee of 9% in an area which only gets 6% at best, there's someone paying for that 9%, and it's more than likely you through the purchase price. So be wary of deals that sound too good to be true. Don't get hung up on rental yields. The reason why I say that, quite simply, is when we look at investment opportunities, the majority of the time, there is exceptions to the rule, we are looking at a combination of the rental yield and capital growth. Now, in South Africa, we're not as good, and we don't have the kind of data and information available to look at the growth prospects as clearly and precisely as they are able to in the UK and other markets. That's why it comes into play, because we can look at how the population growth is, what's happening within the economy, job opportunities, supply and demand, all these different factors. So you tend to find that most of the time you're looking at both a rental yield and capital play, and what you ideally want is a cash neutral investment from day one and benefit from that. Treat it as a medium to long-term investment. If you want to get the best out of property, please do not think you can go into somewhere, make a quick buck and get out. There are entry costs, exit costs, and costs whilst in there. And the days of being able to, for example, exchange on a contract and then sell that on to someone else have gone. Really, within the investment portfolio, and these great Carrick advisors will say this to you when they're looking across your portfolio, it's about diversifying and balancing your portfolio, within what our opportunities are. Hence why we're in tier 1 safe haven countries, and not looking at these, once in a lifetime, let's take a risk with this island because, I hear it's going to do great things. So rental guarantees, I've mentioned that. Ground rents, I've mentioned that. High service charges, just have a look at those. You pay them. and you know, places that do have huge, you know, sort of, they've got a concierge, they've got a gym, they've got, you know, everything you basically want, car service, the whole lot ski. You pay for it within your service charges, and that has a very, you know, has a direct effect on your net yield. So do just look out for those. Requirements for large cash investments during the build. So, you know, if you've got a development where you're having to put in 50% of your own cash during the build period, or anything above 20%, ladies and gentlemen, you just keep an eye on that, because strictly speaking, unless you're told otherwise, only 10% of your money is protected at exchange of contracts. Anything above that can be protected, but that would have to be negotiated. We do that on behalf with our schemes in the majority. So when you are putting in a lot more, you know, 30–40% between exchange and completion, if things go peak tong, if you know, the builder goes bust and there's that doesn't complete, you won't get any of the additional above 10% back. Very large developments, you know, when you've got 400–500 unit developments, you know, for me, it's just something to keep an eye on, because these big developments, you know, there's just going to be a lot of stock coming at the, you know, on the market at the same time, so it takes time to rent out, and then they very much of a likeness, you know, every one bed is in there, so when they come on the market, because there's so many 1 or 2 bedders, they all come on, you know, you're going to have a far larger amount coming on at the same time, and therefore, you know, trying to get a tenant, you're going to have to reduce your prices and so forth and so on. It's the obvious that I'm stating here, ladies and gentlemen, but I just, you know, sometimes it's worth stating the obvious. And then finally, you know, for those that are obtaining mortgage finance, I'm not concerned about the situation. You know, I believe that there has been, and I won't deny it, there's been a reduction within the opportunities that are available on the mortgage side, but there still are great opportunities. But that has more to do with this pandemic and obviously the economy. And I believe that once the economy strengthens, and more importantly get through the pandemic, you know, there will be better lending terms coming out. But the mortgage application, for those that are going to be reliant on the mortgage, make sure that, you know, as soon as you're able to make that application, that you do, and you don't leave it to the last minute, because with the reduced amount of lenders available for South African investors, those lenders will have exposure limits to developments, and you may be one of, you know, other clients that are buying there, or they lend into the local market and they've reached their exposures, and then you might be told that, sorry, I know we said we could get this, but we can't, and then you either can't get a mortgage, or you're having to get, you know, a product which is the interest rates and is far higher than you've been quoted, and the loan to value is far lower than you've been quoted. Thank you, ladies and gentlemen. Anthony, thank you, and I'll hand it over to you to see what questions are available.
Yeah, thanks, Tom, for that very insightful presentation. We've actually got a lot of questions, and we have run out of time, so I'm going to try to pick just a couple, and if you can answer them quickly, please, and then we'll, for those of the questions we didn't get to today, we'll make contact with you directly. You can also go to www.carrick-property.com. There's a lot of information on the various developments there, and as per the slide, info@carrick-wealth.com to make contact or contact your advisors directly. But just quickly on the question, so the one question is, you know, when you buy property, when it comes to maintenance, it can become a pain in the butt. That's why you have managing agents. Is it worth paying for a managing agent in the UK? How does that work? You did briefly touch on it earlier, but maybe just expand on that because of the question.
Okay. Yeah, very quickly. I mean, what you don't want is the headache of trying to manage a property from, you know, thousands of miles away, quite frankly. The one benefit, obviously, buying off plan and new build is that, you know, those kind of maintenance things don't go wrong very often at all. But the expertise, the referencing, making sure you get the right tenant in there is obviously hugely beneficial. You tend to be paying around 12.5% of the rental income for those agency fees. But, you know, you don't want the headache. However, if you've got, for example, a friend, a brother, sister that lives there, and they're happy to manage it on your behalf, or you've got a friend that you're going to rent it out to, then obviously, take that route. But they are hugely beneficial. Hassle, making sure everything's done, but it's horses for courses.
Okay, and then we had two questions, both on tax related, which is also very, very important consideration. I do need to state that neither Tom nor myself are tax advisors, but we do have a fair understanding. And when it comes to tax, the one question, I don't know actually where you tax resident. The other question is coming from a UK UK tax resident, so someone that's living in the UK but is also paying tax in South Africa. As a general comment, I would say that everyone's taxes are very unique and specific to their countries where they live, where they tax resident, the types of income they're earning. But as a general blanket comment, and Tom, feel free to jump in here, is that you do pay tax at source in the UK. So on your rental income, you will pay income tax. You can obviously deduct some expenses and fees that you've got, such as the rates and taxes and elements of the mortgage, interest, etc. And then you have to, if you are tax resident in two countries, or if you're tax resident just in South Africa, you have to look at double taxation agreements between the UK and South Africa. So first and foremost, it will be taxable in the UK, but you do have a £12,500 allowance, so you only pay tax on any rental income above £12,500. If you have paid already tax in the UK, you can claim a credit for that on your South African tax return. So very, very broad statement. Contact us. We can go through the tax with you because it is an important consideration. Same thing with capital gains tax. You're going to pay capital gains tax. Same thing with estate duty. When you pass away, because of the situs asset, the assets on site in the UK, you do pay UK inheritance tax of 40%, but there's a 325,000 abatement. So only anything above £325,000 will attract that 40% tax. And in certain circumstances, you can roll that over to a surviving spouse, which means anything in excess of £650,000 will be estate dutiable. And again, you're never going to pay tax in South Africa and the UK. You can get a credit for what estate duty you have paid in another jurisdiction if the double taxation treaties allow for it. So very, very broad brushstrokes. Tom, any comments or anything you want to add to that?
Just one thing, be careful that the ability to offset interest, your mortgage interest against your rental income is no longer available. So it was phased out. You won't be able to get that benefit. But otherwise, you spot on, and as you say, it's each individual have their own unique circumstances. So it's something you really need to look at.
All right, perfect. Let's leave it there. 1 hour exactly on the dot. Thanks everyone for joining. Tom, thanks for your time. Very clear that people do need their hand held because there's a lot of different considerations. So if you are considering a property in the UK or elsewhere, please, we look forward to you reaching out to us. Have a great day, stay safe, and thank you again for joining us. And Tom, thank you for your time.
Thank you, Anthony. Thank you, ladies and gentlemen. All the best. Keep healthy.
Take care. Bye.